Hello, Randy Patrick here. Time for Housing Bubble 2.0 news of the week, or as I like to call it, another episode of As the Housing Market Turns or Burns or Crashes or whatever you want to say. What's going on today? Lots happening. Once again, today is Wednesday, June the 12th. Today's topics are mortgage rates and the ReFi boom, FHA increasing its risky lending, zero down for a San Francisco home. Yes, you heard that correctly. Remodeling economics, real estate and foreign buyers, still a hot commodity, and hurricane season. Believe it or not, at least on this side of the world, the Atlantic hurricane season is happening right now. So we're going to get into the second here. Please don't forget to subscribe, help my channel grow. Also, don't forget to inquire about our real estate investment training, short sales, and things like that, which I have been working on with a few people who have come through already. So appreciate that, and we hope to get more involved as well. So on to the news. So here we go. Basically, news of the week is highlighted by a lot of chatter about what's called the ReFi boom. So evidently mortgage applications surged an impressive almost 27% week over week. So the week before to the past week is the largest jump in mortgage applications since January of 2015. Obviously, the 30-year rates dropped back below 4.00. So of course it's the lowest since January 2018. So when that happens, when rates drop, we see the opposite. Rates drop and applications and activity go up. Now, the issue though is that it's the refis that have increased. So this has prompted a sudden 46.5% surge in refinancing activity, and so therefore that's what's driving the boat here. So loan size for purchases fell on average last week, while refi loan size spiked. So there you go. So mortgage rates are not necessarily driving, as we talked about before, home purchasing. It tends to be driving refi opportunity now. So again, refis made up almost 50% of all loans versus other prior weeks, and obviously they say that the spikes in refi activity are not an indication or signal of long-term, property or housing market health. They want to, they say it's because of, short-term, issues with mortgage bankers, advertising, and things like that. So the refi boom, again, rates drop, people pull money out of their properties, they reduce their expenditures, etc. And having said that, apparently when rates drop, someone always does a study where it says, hey, if our rates drop by quarter point, then a certain number more people qualify in that refi zone. So basically they say tumbling mortgage rates have made 6.8 million people refi eligible, which is interesting. And this week's 20-month low added almost 1.1 million borrowers to the potential refi pool. So there you go on that one. And to keep it in theme with respect to lending and mortgage rates, something came out the other day about FHA is definitely increasing lending to riskier borrowers. We have mentioned this before. As properties increase in value, or as they had increased in value, it's making property ownership unattainable for a lot of potential buyers. What happens? Well, FHA, Fannie, Freddie, whoever they are who's endorsing these loans, are adjusting their programs and their criteria to make it easier for people to jump into mortgages. So what basically is saying that obviously share of borrowers with debt to income ratios above 50%, so DTI above 50%, rises to its highest level since 2002. That's very, very interesting, and it's a warning sign as well too. According to FHA's quarterly report for its fiscal second quarter, which covers January 1st through March 31st this year, the average credit score of an FHA borrower fell to 665 in the second quarter. That's the lowest credit score level since 2008, and well below the FHA lending peak score of 703, which happened in 2011. So that's an issue there. So we're getting to lower credit scores, but the issue really is the DTI. So according to FHA report, in 2018, nearly 25% of all FHA purchase mortgages had a DTI ratio above 50%. So 50% of your income is going directly to your housing expense, which doesn't leave a heck of a lot for you to live on or save or manage in case of emergencies. So that number has been rising for several years, a trend that the FHA has noted as concerning as early as last year. But however, despite noting that concern, it's still continuing to increase, and this quarter jumping to 28% of all FHA purchase loans. So it's one of those things that people are stating, okay, we see some issues, we see some problems, what are we going to do about it? But then nothing gets done about it, and the problem escalates, so it's gone from 25% now to 28%. So you can see that's just the way it works. So, again, it's part of the process. So it's the government helping, the government entities helping borrowers or buyers get into probably higher priced homes, or stretching their dollars to get them that mortgage, and off they go. So it's simple as that. They're buying at the peak, and they're stretching their personal economies as far as possible here. So just, again, realize that this is yet one more trend, or one more sort of piece of information that for me screams loudly that we're going to be moving, and we are moving, into housing bubble, potential housing crisis territory. Now, the naysayers, or the people who want to rebuttal this typically go back and say, well, we're not going to have a housing bubble because we have what's called QM, qualified mortgages, and we don't have the silly fund mortgages we had back before the last housing crisis, when subprime kind of had all those issues. Well, I mean, that's great, and if you want to rest your laurels on that, this is stated right here on paper from the government, who's endorsing these, who saying we have a problem, but no one's doing anything about it. So, it's going to continue to rise, and more people will stretching themselves and putting themselves into risky loan products. Simple as that. So, for the people who are saying we have all this qualified mortgages, I think you got to reevaluate your stance on this. So there you go. Now, to make matters even worse, or not worse, I guess you could say, but just to show where our market's going. So we've talked in the previous videos about how technology is changing the real estate marketplace. You have a lot of what we call iBuyers. So basically, third-party websites, applications, groups that are buying and selling properties. You can sell your property to them. You can do everything online. You get your mortgages online now via your phone. Everything is becoming, you get your offers that way, so your home. So things are changing. Well, there's a new real estate startup in San Francisco. It's called Zero Down. So real estate startup Zero Down will help you buy a house in San Francisco with no down payment. Okay, we all know San Francisco is one of the most expensive markets in the country, though it has seen a little bit of a decline lately. Still, it's up there. Comparatively speaking, it's one of the most expensive out there. And essentially, Zero Down officially launched their platform in the Bay Area this past week. The company offers prospective home buyers the option of buying a home in the San Francisco with no down payment and no assumption of mortgage debt by the buyer. The company will provide buyers with keys to their new home within 7 days. Now, obviously, the buyers have to qualify using an online approval process, select the home they want to buy. The company then will buy the house with its own funds and allow the customer to move in the house within 7 days, which is very interesting. But the customer doesn't own the house, nor do they have a mortgage payment. Rather, Zero Down owns the house and will continue to own the house for as much as 5 years. So the whole idea is that this is actually what's called a glorified lease option. So the customer makes lease payments to the company in exchange for purchase credits that represent a percentage of the home's value. Then after at least 2 years of occupancy, the customer has the option to acquire the home from Zero Down with their purchase credits and a down payment. So, as I said, this is nothing more than a well-marketed lease option purchase, and it allows obviously this group Zero Down has I guess you could say raised so far $30 million, and when you think about that, I just think about this right now, going, okay, $30 million, in the San Francisco area is going to get you 25, maybe 30 homes at $1 million a pop. So it's not like it's a huge amount of homes, but the concept's out there. So the company described this model via its website is that Zero Down owns title to the home. At any point you choose to purchase the home, we will transfer title to you. You'll be leasing the home with us with an option to purchase. Once we close on the home of your choice, you enter into two agreements. One is a lease agreement, and another is the option agreement, which gives you first right of refusal. So that's the scoop. So no money down is no money down with a mortgage payment, etc. However, realize that it does require some upfront money from you, and the company does charge its customers a $10,000 fee to buy a house for them. So basically, you're going to pay a fee, and you're going to have the lease option purchase. Now, what's not really explained here is what that lease option purchase agreement looks like. So traditionally speaking, the right way to do a lease option, if you guys are into real estate investing, lease optioning is as a way to, essentially secure future buyers at a future higher price point. Why it works for the buyer is the fact that typically this could be people who can't afford a down payment, or maybe have lower credit scores, can't maybe qualify for a mortgage, but they're probably cash, like they have good jobs, they're cash flow positive, cash flow rich, but they can't get the credit. So what happens is you lease option, which means you lease the property, renting it for a couple of years, and then you put an option down, which typically is money, and you have a specific period of time to exercise that option to purchase the house within that time frame, or that option money is lost. So that's the kicker. So in this little equation here, we know that there's a one-time fee of $10,000 for them for acquiring the property for you. Whether there is another option fee is not listed here and will probably be determined shortly. But again, just pointing out that where there's a will, there's a way. Innovation, of course, people are always trying to find ways to work around the system to help others out and make a few bucks along the way. So it's interesting. I can tell you though that $30 million isn't going to go that far in San Francisco, but maybe that's what it does to what it's used for, to help people get into homes that they can eventually work into conventional mortgages or whatever type of mortgages in the next couple of years. The risk of the I guess you could say, there's risk on both sides. Your strike prices today. So if the prices go down, so if you buy for $1.5 million your strike price and you lease option for 2 years, if the home is worth $1.3 million in 2 years, your option is 1.5. If you choose not to exercise that option, then you may lose your option money, or the vice versa. The people who are the zero down could lose money if properties continue to rise, but I don't see them doing this model if they feel that they'd be losing money. So I think they know that where the market's headed, and they're going to try to rope in some buyers with this model. Again, I don't know much about the company. I just read this off an article. I do think the concept is rather innovative, but we'll see how this all plays out. All right, talking now about remodeling economics. And I saw an interview from the chief economist from the American Institute of Architects. He was reviewing what's a Harvard study that came out, which is really how the remodeling market works. And he said that we're going to see about a 4 to 5% growth in remodeling this year, not the typical high single digits like 8 and 9% that have happened the past couple of years. And he notes the fact that as new construction slows, typically remodeling slows down just after that, slow as well. Reason being, a lot of people don't want to invest in remodeling, because if new construction slows and there seems to be maybe a pause or a change in the housing market, people are reluctant to go out and spend more money on their homes, because again, they just believe that the more money you put into remodeling, you may not get equitable interest out of it if you sell or if the property doesn't appreciate. So he's seen slowdowns in remodeling, or the study has seen slowdowns in remodeling in following areas: Portland, San Diego, Kansas City, Dallas, San Antonio, Pittsburgh, Buffalo, Washington, D.C., and Boston. He's saying, in some markets, you're paying so much for a home that you're priced out, and if you jump into an existing home, you don't have the cash to additionally make some remodeling improvements to the home. So that's where it's pinching some people as well too. They're kind of tapped out with their purchase because of the lack of affordability. Also stated the fact that there's nervousness on the payback. So caution, buyers are being cautious. So they're not going to spend a lot of money on remodeling when you're tapped out on your initial purchase price and you're concerned about the payback and where housing market's going to go. So again, they'd rather sit tight and watch prices to see where they move and watch where the economy heads. That's typically what's happening now. Therefore, we're seeing the remodeling activity certainly slow down a bit. He stated there's obviously an affordability crisis, and where he sees the slowdown on the remodeling side is what he calls the discretionary spending. In other words, high-end bathrooms and kitchen remodels, and remodels where you're adding additional rooms, which are increasing the square footage of the home. So remodels like, updating the roof if it needs it, or your air conditioning system, or smaller remodels, he said, will continue to happen. But he calls these discretionary ones where you're really, that's not a $5,000, $10,000, fix. You're adding another room. That's a lot of money. You're adding a whole new gutting and doing a whole new modern kitchen or bathroom. You're looking at substantial costs for those items. And that's where people are kind of wondering, going, okay, if I spend, 50 grand or, whatever on a new kitchen and deck it all out, am I going to make that back when I sell it? Or is my property going to appreciate and allow me to recover that money through equity? So that's interesting. So again, yet one more thing to me that shows, where our market's headed, and it's headed, as we talked last week with, last video with flipping profit and flipping volumes. We see people trying to exit the marketplace now and get what they can out of the property. We see return on investment slowing down. So it has its trickle down effect to other markets as well too. So interesting enough, foreign buyers. So clearly certain parts of the country, as part of the recent housing boom, were supported by foreign buyers. And what I mean by that is these are people coming in, whether they're buying multifamily or higher end condo apartment developments or single family homes in certain locations. They're cash rich. They're coming across. They're bringing their money, which I call this money typically flight capital in many instances, because they're trying to remove money from their home country, get it to an asset where they can park it here, not necessarily buying and selling and flipping homes, just really parking the money so it's safe. So I've seen that grow, and those type of buyers have certainly increased the expansion, and I guess you say price increase for a lot of locations across the U.S. Miami, the New York area, Seattle, Portland, obviously lots of places in California, numerous locations in California. So that makes people upset, but also it gets the money out of the country. Well, what's happening now is that there was a recent interview with the president of Lennar International, which Lennar builds homes, and he basically said that foreign buyers are looking to the U.S. for a residential real estate market for long-term stable investment. So the people who are bringing their money across, they're not buying and reselling or fix and flipping. They're typically buy and hold and let the money park itself. So he said you're seeing a lot of this consumer behavior, especially from buyers in Japan who are moving away from yield and more focused on stability and self-use. A lot of people, and just so if you don't know, buying a home in the U.S. Certainly helps start the process to landed immigrant status, visa status, and citizenship ultimately. So that could be some motivation for people as well too in the future. He added, while there's been a decline in interest from Chinese buyers in California, Chinese buyers are looking more into properties in Florida, Texas, and along the East Coast. And obviously Chinese interest in China is still pretty evident, but they're moving away for higher priced homes. And you knew this had to happen at some point in time. With such huge prices on the West Coast, you take a look at what you're buying for $1 million in California. You can probably get 3 to 4 minimum properties here in Florida that you can either fix and flip, you can cash flow and hold, etc. So people are looking at better location for better prices, even if they're foreign investors as well too. So one thing that I realized too when I was looking at this, that this referenced the Wall Street Journal, that the Wall Street Journal reported that real estate investment trusts, otherwise known as REITs, people, these are companies or trusts or funds that buy residential property, that they have increased their mortgage bond portfolios by about 28% to about $308 billion over the 12 months through March. This is the largest cash stockpile in 6 years, according to the Wall Street Journal, and they're poised to continue to grow as the government's housing market will shrink. So, as I've mentioned before, this is where the economy is headed. We're going to see, and this is part of my theory as to where things are headed here, and we'll talk about that in the next. I'm building playlists for all this. Believe it or not, it just takes me a while to get everything through. But the point is that the single family residential investment is a asset class that a lot of people want to get involved with. So hedge funds and REITs are amassing a ton of money, and they want this housing sort of bubble to burst and the crisis to happen so they can swoop in and purchase more of these homes. Now, they don't buy at the peaks. That's the whole thing. So you want to go to a hedge fund now and say, hey, I got my great property here. Do you want to buy it from me? They're not going to buy it at top dollar because for them, that economic model doesn't work. They need to buy it on discount. And they get discounts from what? From where? From lenders who are taking back properties via foreclosures, doing non-performing loan or non-asset transfers behind the scenes. They buy them at the foreclosure auction where they're getting them for what they feel are good prices. And they'll get this from other real estate providers, wholesalers, whatever. So realize that, asset managers from banks, whatever you want to talk about. So realize that these groups do not buy premium. They don't pay, they don't pay market or compete for properties. They want to buy distressed or things, at discount rates, like we all do, of course. But they've got the billions of dollars to make this happen where we don't. So please realize that this is a sign of things to come. But I wanted to just focus on the fact that, as I said, the foreign buyers maybe are shifting their focus a little bit. They're not going to be buying the mega mansions and these huge expensive properties. They're trying to diversify and take a look at much more value for stability and long-term growth. All right. So having said that, and this kind of tees it up as well too, is we now have entered into hurricane season. So June 1st was the official Atlantic, hurricane season. It runs from June 1st to really the end of November 30th. It's about, how many months? It's roughly 6 months right there. And, every year there's a couple of groups that publish their sort of hurricane or major storm predictions, for the next season. So one comes out from Colorado State University. They've been doing that for about 35 years. And one comes out from NOAA, which is the National Oceanic and Atmospheric Administration. That's a mouthful to say there. So ultimately, in the end, on average, they're sort of both looking at around 12 to 14 storms. Those are named storms that are going to appear in the Atlantic Ocean. 5 to 7 of those storms will become hurricanes, and 2 to 4 of those storms will become major hurricanes, which is, I think, a category 3 and above. So this is about normal, slightly above normal prediction. I think 12 is normal storm, so 12 to 14 is slightly above normal prediction. That's what they're looking at here. And why I'm talking about this is because when we have hurricanes, and they're disasters, all right? We've seen the disasters in, on the eastern seaboard, in the Panhandle, in the Gulf Coast, areas of Texas, obviously, New Orleans area, like Louisiana, Mississippi, Alabama, low-lying areas where we're seeing a lot of flooding, a lot of issues. Obviously, Houston had some major issues. This is just one issue that adds to delinquencies and causes problems for homeowners. This is just on this side. If I go to the other side, which I'm not too familiar with, obviously there's a hurricane season that goes on the Pacific coast. I'm not too sure how much it really hits, that side of the U.S., but we have things like earthquakes and we have wildfires that have wreaked havoc. And with those wildfires come a lot of other issues, because the forest, gets ruined and burned, and you have then rains which cause mudslides, whatever. So there's a lot of natural disasters that play havoc with the real estate market, and in turn cause people to not pay their mortgage, which means they become delinquent and face foreclosure. So disaster mitigation is difficult, and just want to keep in mind that that's what typically happens. We've seen that over and over again. Somewhere in the U.S., we're going to have a landfall hurricane that's going to cause problems, and and then people from 6 months to a year from that time frame will be in the foreclosure situation and having issues. So just be aware of that. Not a good thing, but if we can go in and help them and figure stuff out, that's obviously a positive situation. So that's it for today. Lots that we spoke about, but I think today's focus mainly was rates and where things are going and how that messes with the market. My sort of point or takeaway is that we've seen refi surging, which means people are not putting their property up for sale. They're going to take their money out and their equity out. So that's going to contribute to the lack of inventory that's out there, or the fact that people believe that values have peaked and they're going to decline. So if they're not going to sell, they want to take what they can out of the property and face the issues down a couple years from now. That's the scoop. So anyway, everybody, thank you once again for the views and the likes and the comments. Please subscribe, help my channel grow. YouTube is changing some of its algorithms and some of the things on how they rank videos, and I can already see it affecting my stuff. So again, all I'm trying to do is provide commentary and realism to what is published news articles in the media about the housing market. That's all I'm trying to do. So anyway, take care, and we'll look forward to seeing you guys or talking maybe early next week. Bye-bye.